This is 7 key personal finance lessons that have transformed my life. If you apply these lessons, they can transform yours too. Lesson 1. The power of delayed gratification. Delayed gratification is crucial for success. The ability to resist the temptation of immediate rewards often leads to significantly better outcomes in the future. For instance, in investing, the longer you hold on to assets like stocks or retirement funds, the more time they have to grow and compound. That's why financial experts stress leaving your savings or 401k untouched. It's all about letting your money work for you over time. A simple rule for everyday purchases. If you can't afford to buy it twice, don't buy it. For example, if a $500 purchase feels manageable, but a $1,000 expense makes you uneasy, it's likely a sign you shouldn't make the purchase at all. This principle applies to major life decisions too. By zooming out and considering how a choice fits into your 10 or 20-year plan, you can make decisions that align with your long-term goals. Lesson 2. Track the big 3. To improve your financial health, track these 3 numbers. Expenses. Monitor both fixed and discretionary spending. For fixed expenses, e.g., housing, transportation, aim to keep them below 50 to 60% of your income. For discretionary expenses, set a monthly target and check in mid-month to stay on track. Savings rate. Start by saving 10% of your income and gradually increase it over time. Net worth. Tracking your net worth provides valuable insight into your financial progress and peace of mind. Regularly reviewing past data can motivate you to keep improving. Lesson 3. Simplify your investments. You don't need to invest in dozens of ETFs or stocks. In fact, too many investments can lead to overlapping holdings and unnecessary complexity. For example, if you invest in Vanguard's S&P 500 ETF, VOO, and its Mid-Cap Value ETF, VOE, you might unknowingly duplicate holdings. Instead, stick to 1 or 2 well-diversified ETFs for simplicity and better long-term results. Remember, most casual investors who stick with index funds often outperform active fund managers over time. Lesson 4. Be mindful of depreciating assets. Big purchases like cars, electronics, and furniture lose value over time. The worst financial move? Borrowing money to buy something that depreciates. For instance, financing a $2,000 couch that sells for $200 3 years later is a double loss. You're paying interest to own something that's rapidly losing value. Instead, aim to pay cash for such items and focus your debt on assets that appreciate. Lesson 5. Long-term investing pays off. Investing consistently for more than 20 years nearly always yields positive returns. Data shows that over any 20-year period, US stocks have never had negative returns when dividends are included. Even if the market seems overvalued, staying invested is crucial. Many who avoided investing in 2012 due to perceived market overpricing missed out on a decade of significant gains. Lesson 6. Saving comes first. At the start of your financial journey, aggressive saving is more impactful than investment returns. Building an initial nest egg allows compound interest to work its magic. For example, if you save $13,000 annually at a 7.5% return, 77% of your $101,000 after 6 years will come from savings, not investments. The key is discipline and persistence in saving, especially when starting out. Lesson 7. Investing should be boring. Successful investing isn't flashy, it's about consistency. Buy into diversified index funds, dollar-cost average, and forget about it. As author Morgan Housel suggests, losing the password to your investment account is often a sign of successful investing. The goal isn't to beat the market, but to ride the wave of long-term, steady growth. Conclusion. These personal finance lessons have been game changers for me, and I hope they'll help you too. If you found this video helpful, don't forget to like, subscribe, and share it with someone who could benefit from these tips. Let's keep building our financial futures together.